Okay, welcome everyone. Let's start our lesson 3. Today lesson will go through our LO3. As you know, my name is Satha. If you have any question, drop me email at anjum@university.co.uk and I'll try my best to get back to you as soon as possible. Okay, so let's start. Thanks for joining. And today lesson is about LO3, which will be able to apply the taxation planning to minimize the deferred tax liability. Okay, so previous lesson we discussed about the ethics. We had a discussion about popular people chat in office, professional behavior, professional competencies, and UK confidentiality and integrity. And we had a discussion about Finance Act, whichever year of Finance Act you will use, so you carry on. And then we had a discussion about inherent tax and the benefit, the car allowance and the mileage you can claim, which we had a discussion. So this week, please, is the tax planning is illegal, will grow more, where our discussion will be focused on the ethics and different types of ethics. So anyone, any question during lesson, so please feel free, indicative content. So all these are the key points, which we'll cover to the lesson and understand the legitimate tax planning, which we'll discuss about mitigate taxes, based on numerical analysis and the reason behind, which we'll discuss about. So this is Finance Act. You can follow whichever year, please, you can look around the latest rate and just a matter of finding the latest rate. So that's the key which we need to, and we'll start this. So we have 3.1, evaluate the types of investment and expenditure resulting in reduction in the tax liability. So please always remember the depreciation is not allowable expense for the taxation purposes. What we need to do, we can plan taxes by looking at the capital allowance and annual investment allowance, which is we've been given. So that's which we need to be follow our annual investment allowance. That's it's quite crucial, which we can plan accordingly. And so whichever finance sector you're looking, so annual investment allowance will provide you allowance of 100%. So if you have the tax, you claim annual investment allowance, that tax bill will be reduced. And expenditure, plant and machinery, which we can look around any expenditure with excess of this limit, which is million. So we can look around the qualify for the written down allowance as a normal. We can apply these, and capital allowance, which is mean any asset you buy, and we can proportion, and we can look around these, and we can reduce our tax bill. So that's we need to be look around full years, and if your asset is being disposed of, so we need to be proportioned accordingly. So we included few examples, please, to just clear concept, which I shared with you last lesson. So let's please look around the prepare account for the 31st March and the 1st April. The written down allowance value of the plant and machinery in the main pool is a given 16,700. Then we can look around if you purchase cars, we can look around those, and we had all of this capital expenditure these, and we can make adjustment accordingly in, and that will help you to tax bill. So what we'll do, you will see which asset is fall in the main pool, the car, special pool, and allowance. So that's written down value which we can we have 16,700 which we carry forward, and we can look around addition the qualifying for annual investment allowance. So we have the equipment we bought it 98,750 and 100% because that fall within the limit. So this year it won't be any tax on it. Yes, so it can be exempt. Other additions, we have the car 15,600 And then we have the second car, which fall by looking the CO2 emission level, that fall under the special pool. And then we have the third, so we can look around other 18, 28, 300. So that's, which we can add them all together, and we can find the total value. So whatever the special pools and things, so we need to be proportions accordingly. So please, we can calculate. So up to that limit is exempt. So we can look at written down allowance is 18% of the man pool, which we can man pool that was, the total adding them, and we minus 16% of 45,000. So that's, which we calculated, and the written down allowance under the car, which we can again, and written down allowance under special pool. So please, we need to proportions accordingly, and that's, which we need to calculate. And then we have the remaining amount, which can go be additional qualifying first year allowance, can be couple of assets. We need to be look around again under the finance act. So qualifying criteria, that will help you to be calculate your taxes. Of course, when we're using specific software, that will automatically these rates are embedded and we can use. So for assignment purposes, so car is kept, separately because they are the private user, and this car, had the CO2 emission level between 1 to 50 grams, and therefore the qualifying, written down allowance at the rate of 18%. So we need to be looking around the qualifying criteria for this, and car 2, which had the emission level 50 grams per kilometer. So we can look around this criteria is included in the pool. Then we can look around the car 3 is the emission level between 1 and 50 kilometer grams, and this is pool is the 18% of the rate applied to this, and the car had the zero qualifying 100% in the first year allowed. So we can look around the CO2 emission level, and then we can look in the rate and the categories of the asset that will help you to clear. Okay, next, zero carbon, new car with a zero carbon qualified 100% allowed. So the car effectively deducted as an expense for the year of the purchase. It provided a car, and then 2% car benefit, which we can look around available, the minimum amount and income tax implications. So please, we need to be look around again the finance act, whichever finance act you're following. The annual state line allowance, which is unchanged, the 3% with the relief being and given to 33.13. So 33 years and 4 months, it can be claimed. So we can look around structural building allowance, which we need to be further. It's not being changed a lot. So we need to be look around it. Let's look one more example in this case, please. We've been given the period is 1st July, and the company purchased, newly constructed factory for the builder, and the value is 470,000, and including the land, which is 110,000, and the factory bought to use on the first. So qualifying expenditures, which we can 360,000, because the land is not, and we need to be take out the value of the land, and the factory bought into the use in the first. So we can find the period until, because that's not 12 months up to 31st March. So we need to be proportions accordingly, and we are entitled the rates, so all allowance will be, and that will help, so we can look around the separate chapter on capital allowance, please. For the tax purposes, this is not deducted on the cost an asset, its profit as the depreciation. We are entitled for the capital allowance. We have to look around which category and the value and the rates, that's, is applied to. Is this annual investment allowance, the first year allowance, and special, and we have to categorize the original cost of the asset, cumulative capital allowance claim, and written down value. If you dispose of the portion of the asset, we need to be, and then further, if any value left, then we'll carry on. That's, which we need to be The timing of the asset bought, please, that's also is good to be. You need to be the date of you purchase, date of use of the asset, and you need to be proportion and the claim accordingly, because otherwise it's not the tax compliant purposes. Of course, nowadays of software that you need to put, and then you can calculate accordingly. Yes, trading losses and NP, their net present value of the asset and future cash flow. That's we can look around pension and other tax efficient investment products like the pension, enterprise investment schemes. Those are some special schemes we have to look around the relief. So types of the trading losses, we have to last the relief, which we can look around. Again, the profit of the qualifying, the period and up to 5 years carry forward of the brought forward, the profit which we can for the tax management of tax planning purposes. So please, if you have any question, you carry on asking. So reviews the legitimate of the tax planning. Of course, tax planning is illegal, as we said, and the couple and the civil partners and the capital allowance, because this unit is individual as well as the business tax, which we are looking. So in the Samantha are the married couple, they have the tax, of 2023 and 24. If we look, at the salary income, in there's a 90,000, that the salary income is 30,000 and saving income is 50. So when it's 90 more than 50, just a state, you're the higher tax payer, and the rate will be the 40% on after that. So you have to be think about the rate and then tax planning if you want to advise your client accordingly. So we can look around the saving income. The rate, the band is 1,000. The remaining 500 for our saving income will be taxable at the rate of 20%. Higher rate is the taxpayer, and so the saving income nil rate band is 500. In that case, because if you're not a basic taxpayer, it can go to the reduction in, otherwise it's more. So you have to be think about and the transferring the sufficient saving to, in that case, will, so the receipt of the 500 saving will therefore save the income tax of 20%. So that will be £100 saving in the tax planning purpose, which we need to be look around and transfer it. So dividend, so first 1,000 of the dividend for the tax year, the benefit of zero rate, and the 1,000 nil rate band is available for all the taxpayers, and regardless they pay the tax and the basic and the higher additional. However, the dividend nil rate is count toward the basic rate and the higher rate band, and the dividend income is excess of the 1,000 and nil rate band. So we have to be think about in that. So please, again, I showed you in lesson 1 the rates 37,700 and 12,570, and then of course we can look around the partners in the marriage allowance. So that the dividend is on the rate is 8.75. If your income is, if you're more than that, it goes straight to 37.75, and if because the higher threshold, and if you please higher than that, your personal allowance will finish, and then jump 39.35% the dividend rate. So we can look around here, this example again. We can see the salary income, dividend income, employment income 62, dividend income, and the total income, and then we can look around 12,570, and then we can the dividend income 2,800, and then we minus the income tax 20% on 37,700. The remaining between, because if you minus from 62,500, 49,993, 37,700 is the basic rate, and other than that, it will be applied the additional rate of the capital allowance. So please, that we need to keep in mind. And then if you look the dividend income plus 1,000 is exempt, because that's the next 1,800, which will percentage the tax accordingly the higher taxpayer, so that will apply the higher rate. So 33.75% instead of 8.75. So that's we need to look around, and then we add all. So that will be your tax liability 13,000 40 if someone's income is 64,000, 65,000, so 13,000 they're paying the tax on it. Any question? This just the tax, not NI. Okay, so please again we can look around employment income, dividend, and I included good few examples so far. Your assignment for if you want to add any example. Keeping your GDPR, so please make sure that your client information. So that's we need to be make sure we look. Then we have saving income, which we said earlier. So we need to be I included for that example non-saving income, which is employment income, saving income, dividend income in that case. And please you can look around 47 interest paid toward the job, any personal allowance, So please, these we can minus those expenses and we can find the taxable liability, enjoy higher taxpayer and the dividend rate is, and then we can look around if any partner, then we can transfer and we can advise them. Relief again, the total profit, because as we mentioned, up to 5 years, for example, the profit before qualifying 56,000 and trading last year. So we can adjust the loss and the remaining losses can be transferred up to 5 years if we have the carry forward and carry backward is example there, please. So the corporation tax, please, we look around the trading income, other income, chargeable gain if we have, and we can look around the front, carry back and carry forward. That is quite crucial if we need to be. So in these, few examples, if we can look around carry forward and the brought forward, that will help you. Okay, so suppose for the previous accounting period can be carried backward if you have the previous liability outstanding, that will help it just, and the proceeding are if the loss is not being fully adjusted, you can carry forward and that's it, which we can look around the factor, considering and release. Does the company earlier release and release as soon as possible in better that will help it reduce the tax liability. So the higher tax relief, in the grant, the carry back plan, and we also prefer the UK taxation rate following. Capital losses automatically release again the current period, chargeable gain, which we can carry forward and release again in the future. So please, if the value of the asset drop and you have the loss, so we can look around in the light of, if it damage, and you have now you have the chargeable gain and chargeable losses, which we can think about spending amount. If every £100 spent on R&D, so liable tax deduction is original £100 plus for the 130. So total tax relief is 230% can be, so which we can look around the loss, maybe spend it to the cash payments, and indeed, which we need to be look around the revenue and capital expenditure too. We have the personal services companies, IRS 35. That's because like a subcontractors and things, those we need to be look around, and the client, the owner, and the public. That's they have really impact on. So the control and IRS 35 record insurance and I contribution and the sign of the valuing engagement include the worker cannot be which we can look around. The worker is provided with the tools and the equipment by the client company, and the company deducted hours and the dedicated hours, which we can look around those. Then we have the please 3.3, which we can look around, evaluate the mitigation of the tax of individual. And when they provide the tax planning advice, the client, they are fully responsible for the tax for the year. The fundamental principle, which we discussed, 5 professional code of ethics in line with arrangement with the HMRC. Disagree, and we can look around the legal compliance. So please, we discuss about popular people chat. So these 5 in the light of you can advise to client. So tax avoidance is our attempt to be in threats to the fundamental principle, and it can be fine, it can be listen imprisonment, and we can look around the rules of HMRC in these perspectives. We're not supposed to be hide things, we can justify things tax direct tax avoidance, promote, direct tax avoidance scheme relating to the direct taxes, income tax, national insurance contribution, capital gain, inherent tax, these can be notified, the required, promote the arrangement, and which we can the benefit a person that may falling the comply with the disclosures, so liable the penalties that can not exceeding the 5,000, and value added tax, the scheme which we can look around. We had a discussion in previously the annual accounting, flat rates, and things which we can, and serial tax avoidance. So taxpayers maybe have the tax avoidance scheme, which we can special scheme can be, and that can be arranged, which we can look around these. And if you want to work towards the merit criteria, please evaluate the ethical and professional issue arising the tax planning. So of course, ethical side, professional code of ethics, different direct tax avoidance schemes which we can look around, VAT avoidance, serial tax, avoidance, and which we can general acceptable accounting practices, which we can in the light of. So ethics is the tax avoidance scheme, which we can the fundamental principle, disclosure information, prospect clients, and the tax, irregularities, and please, we can look around tax, on the tax avoidance scheme, VAT avoidance, and then serial, so we need to be look around those in, and we need to be planned. So please, if you want to look around the merit criteria, so if you're adding the conflict of interest, you're looking the professional people, the work in the best of the client, protecting your professional ethics, not involve the family friends affairs, if number of years that can be, so our back-end commission. So these are, number of examples which we familiarity threads, which if you're knowing number of years each other you find, maybe that leads to maybe different people here. So that's, it help you to safeguard intimidation. We're not supposed to be in terms of the jobs risk or any other advocacy thread. If you do advice for this and they are competing each other, so these sort of, if they are going to take over. So safeguard is the best measures. Of course, we need to be like not issuing on the same person all the phases of the clients, dealing. You can delegate, and you have the policies and procedures, you have good communication in place. If you want to look around the 3D one distinction criteria, please, the current issues in taxation, of course, tax planning is illegal, the tax surveillance is happening, tax going to be digital, and digitalization and new rules, and the people declaration, and transferring losses and adjustments. So these are the biggest issues which we can, any issues you can pick, which I included few here for you, and please, which we can, please see the handouts, question one and answers, which I'll share with you again, and that's, we included the link there, and you can pick examples. Any questions, Sarah, if you like to ask, please? Okay, Abdul, any question? Okay, I'll share with you the handouts, good few question and answer, the activity sheet that will help you for to look around the capital allowance, the chapter capital allowance, which I already shared with you, the booklet, please. It's good to be look around a few examples to apply the main pool, special pool, and these, the capital allowance, and the rate, and we can look around finance act, always, and we following the rates accordingly. That's all from my end. If anyone any question, anything you like to ask, please, we can discuss, otherwise we'll keep up to here. And tomorrow lesson we'll go through LO4, and then we'll go through few activities, to apply these rates, which we already covered. And that's, and then next week we'll do the assignment discussion. And when we'll do assignment discussion, we'll pick, good few numerical side, and we can discuss, and we can embed example in our writing. That's because it's not exam-based course, it's assignment-based course. So, but still, it's good to be, we have the understanding, most of you dealing with the basic, taxation and tax rates every year. This carry on changing, and we need to be focused on Finance Act, whichever you're going to follow. That's the key. Anyone, any question before we finish? Thanks for attending this session. Hope to speak you all tomorrow. Thank you. Have a lovely weekend.